Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
I'm Aarati Krishnan, consulting editor with Business Line. Welcome to the State of the Economy podcast. This is this month's personal finance section. We have with us Mr. Chirag Mehta, Chief Investment Officer of Quantum Mutual Fund, who's been handling commodity investing and alternatives for the last 2 decades. So today we are going to discuss a subject that is very close to many Indians' heart, that is gold, and what is the outlook for gold and what are the kinds of investment options in gold. Coming to the first question, for the last 4 or 5 years, we've seen many distress situations in the global economy. Starting from this long pandemic that nobody expected, then this question of whether central banks had printed too much money and had rolled out very large stimulus, which led to worries about whether even the US dollar will get depreciated and whether all paper currency is losing value, etc. In this environment, gold has somehow, even in the international market, it has not delivered blockbuster returns. It has performed okay. Why do you think this has happened?
Yeah, I kind of agree that many of the scenarios that panned out were kind of a Goldilocks scenario for gold. Gold should have performed very well during those times. But if you look at most of these events that happened had a knee-jerk reaction initially,
right,
and then world came to semblance very quickly around it. For example, COVID, the period of Feb, March, April was very, very brutal up till May, and then suddenly we started life coming back to normalcy. Even during the Russia-Ukraine war, for example, we had that war start, gold jumped during that period quickly. And what happened is people were expecting it to spread to other countries and other countries getting involved in the war and kind of emerging into a bigger thing. But that didn't happen. It just got restricted to Russia and Ukraine. Of course, there were certain countries they were shouting from outside, but really it did not
Nobody
spread.
Joined.
Exactly. So all these events that took place kind of had a knee-jerk reaction, and then it was very, very restricted in terms of its spread, or world kind of adjusted to it and became very, very normal event kind of thing after that. So that is where each time we saw a jump in gold prices and gold prices coming back again. Coming to the main issue of monetary printing that happened across the globe to fight the pandemic and support the economy. What happened then was, at the same time when post that, as gold went up to all-time highs, and then it started falling because central banks came in and said that earlier they did say that inflation is transitory, that's not going to be a structural thing. But then they accepted that it's not transitory, and they came in with waging war on inflation, with increasing interest rates to a significant high level. If you see US interest rates, they kind of went up by 500 basis points roughly over a short span of time, like in a year's time. So even with the monetary policy, what happened is that the central banks kind of came with a waging war, and they kind of increased interest rate. They also said that they will kind of tighten liquidity, and all the monetary excesses they'll try to drain out over a period of time. But monetary base even today stand expanded. So if you were to look at gold per unit of currency in circulation or as a percentage of monetary base, it's still very, very undervalued. So you could see that slowly over a period of time gold gained ground because of this reason. But currently the focus is on interest rates, high interest rates being offered, and therefore monetary money flows from investors moving into that fixed income instrument rather than going into instruments like gold. So over a period of time, we do expect that whenever there is a U-turn in policy and rates start coming down, again that focus will shift to monetary base that is enlarged currently, quite expanded across the world, and therefore gold should start doing well.
So do you think when the Fed actually starts shrinking its balance sheet, which it hasn't done yet, it's still at 8 trillion now. So when it starts shrinking, then we could see some impact of this on gold?
So if you look at, there have been attempts previously where they have tried to unwind their balance sheets. If you look at 2018-19, they tried doing that, but they had to reverse course in 1 year's time. And if you look at the growth that we've seen or the recovery that we have seen since the pandemic, has been significantly large because there were money being handed out to in the hands of people. And that savings glut is fast eroding now. So if you look at that, it created excess savings in hands of people, which is now dwindling because they have spent out most of it. So now that support to the economy from say monetary printing or from that savings that went to people, that is fast dwindling. So the consumption or a robustness of the economy that we saw all this while in the US was because of that fact. Now that support is waning. And slowly, as the economy slows down, which we are seeing early indicators of, as you see the housing market slow down, if you see the consumption to some extent holding up, but certain pockets are still showing signs of distress or slowing down at least. So as the economy starts slowing down and it kind of takes shape in form of reaction in the financial markets, that is when the Fed will start reacting faster. So they may do some unwinding,
Right.
but we don't expect it to be a very large unwinding they will be able to do. They will again have to take a U-turn, not only in interest rates, not only and also in tightening measures
Right.
that they are doing. So whenever that happens, we think that gold will start getting repriced and all the monetary excesses will start showing up because gold, as compared to them, is still very, very undervalued. So whenever that happens, which could be 6 months, 1 year down the line, but as we kind of move towards that scenario, gold should start doing well.
So, for investing in gold for Indian investors, there are a few avenues. Physical jewelry suffers from a few disadvantages, like you can't liquidate at the market price because the jeweler tends to deduct a substantial element. So, the paper forms, if you see, there are gold ETFs and then there are sovereign gold bonds. Now, many experts recommend sovereign gold bonds as the superior instrument because they give you an interest rate along with the gold price appreciation.
Right.
So, what are your thoughts? What is the case for gold ETFs?
First, I'll begin with the context that you said that in a gold jewelry market has to, or investors have to kind of differentiate what is for consumption. There you don't have a choice other than jewelry. But when it comes to investment, it has to move towards price efficient forms. So that is one clear understanding. Now, when it comes to efficient forms of gold, like the gold ETFs, gold saving funds, or gold fund of funds as they're called, or the SGBs. So SGBs, from a return perspective, I think they will give the highest return to any investor. But gold is brought in a portfolio context as a diversifier. And what is the use of diversifier? It's not just to keep it on an as is basis that when an event happens, it will help my portfolio.
Yeah.
But it is active managing that portfolio as well. So when it comes to equity markets going down and gold goes up, that's a good scenario for gold, and that's why you have invested for gold. But at the same time, it calls for selling some gold position because it become overvalued from your allocation perspective, and invest into equities, which has become a
Right.
lower portion of your portfolio.
Right.
So that has to be done. That is how you can augment your returns on the portfolio. When it comes to SGB, given they are very, very illiquid, and they are illiquid for a purpose because they don't have a backing of gold, and therefore that does not allow the fungibility to happen, and that is why they quote at a discount.
Yeah.
And given that fact that you might be earning today, but when it comes to time to sell and rebalance your portfolio, you might be selling at a discount to
Right.
the prevailing price. From that perspective, gold ETFs are very, very liquid instruments. They have been in operation since 2007. So they have known liquidity, you have known gold backing to it, known fungibility. So they more or less trade in line with the prevailing gold prices, and that helps you efficient rebalancing of your portfolio. So I'm not saying that SGBs are not safe. They are safe because they are backed by a sovereign guarantee. But at the same time, many investors want that I am buying gold and it has to be in form of gold, right? So gold ETFs, to that extent, are true to that fact that they are backed by 100%
Right.
physical gold, 24 karat, and therefore that gives many investors
Right.
that comfort that I am investing in an instrument. So both these purpose, if anyone is looking for.
Yeah.
And I think the liquidity is one of the important parameter that one should look at. I think gold ETFs thereby score over SGBs. The fact that you get interest over and above the gold prices is a comforting fact. But when it really comes to realize that,
Yeah.
it may not be very, very useful because you might give away that in form of lower liquidity that it trades at.
Yeah. I do agree. I mean, sovereign gold bonds are just another form of government debt. So, if you already have a gilt heavy portfolio, this is another form of a gilt actually.
Yeah, and to the fact that also many people think that gold as an asset is no one else's liability.
Correct.
And you are here somehow
So, it's a
changing the
hedge
form.
against governments also misbehaving. So, that is the kind
Absolutely,
of.
absolutely.
Yeah. You talked about liquidity, but we do notice that not all ETFs are liquid. And actually, when investors go to buy or sell gold ETFs in the market, and sometimes they find that the price is way of the NAV underlying. So every time the investor may not be checking the NAV, etc. So how do investors ensure that whatever trades they do in gold ETFs, they do capture the full returns and don't result in unnecessary discounts or premiums?
So when you look at a gold ETF, gold ETFs, many investors buy and hold for a very long period of time. So they may not trade or show that kind of volume. So what an investor should see, what are the bid-ask spreads? If they are very, very tight on a continuous basis, then probably you know they are real.
Okay.
If they are very, very far apart, then probably you should avoid that kind of scenario because you don't know how they will pan out. But on a regular basis, if the bid-ask spreads are very, very low, irrespective of the volumes taking place, you should look at those kind of ETFs. Another way to for the investors to look at is there is a product called gold fund of funds or gold saving funds. They kind of help you overcome this issue of what is the right price thing, because when you invest in the fund of fund invests in the gold ETF, and the fund manager who buys that gold ETF knows what is the right price and what price they should pay for it.
Right.
So from that perspective, one might argue that it comes at a dual cost, but that cost is very, very minuscule. For example, in the quantum gold ETF or quantum gold saving fund, we don't charge any management fee. No fund of fund is allowed to charge management fee, but the incremental cost is only 6 basis points per annum,
That's very
which
low.
is very, very low.
Yeah.
And sometimes brokerages that people pay to buy gold ETF may be higher than the brokerages we pay at the institutional level.
Right.
So if someone is paying, say, 20-30 basis points as brokerage, we pay about 12 basis points as brokerage. So that
Right.
could be a big differential that they could play on, plus get price efficiency because the fund manager knows what price they're buying
Right.
into.
Right.
And therefore they have very, very good convenient product. They can do SIP in that product, and they have price efficiency that they're looking for.
Right, right. Now, investors in India also have this alternative of buying silver ETFs. So, are gold and silver ETFs sort of substitutable, or are they completely different animals?
Yeah, so silver is sometimes called a poor cousin of gold to some extent, and people think that whenever there is a rally, I'll capitalize on because silver.
And when there's a gold rally, people feel if I buy silver, I'll get more returns.
Correct. It's like people think that's a leverage play on gold in some sense, but it's not really. Like if you're looking as an investor, so if you understand silver market demand, supply, and why prices are moving up, and you want to play that rally, it's a good instrument. But if you see or notice, the entire bull rallies that we have seen in silver have generally been back of speculation.
Okay.
So if you look at the Hunt brothers, or if you look at the recent phenomena where there was a cornering of market again.
Yes.
So each time we have seen that rally are mostly speculative in nature.
Okay.
Also from an allocation perspective, I think gold is more suited than silver because silver is an industrial commodity.
Right.
About 65 to 70% of the usage of silver is for industrial purposes. When industrial use will expand, when your economy is expanding. That is the same exposure you get with your equity investments, because equities will do well when economy is expanding.
Right.
So from a diversification point, silver does not suit well because it's giving you the same exposure to your predominant asset class, that is equities.
Right.
Whereas gold is very, very different. It is kind of chased after when there is signs of distress, economy is not doing well, and investors kind of move into the safety of gold to some extent. From a diversification standpoint, if you're looking at an allocation to gold that it will help my portfolio during bad times, then probably gold is a better asset as compared to silver, because silver, even though there is economic distress, then it will fall along with your equity exposure that you have, and therefore it won't help your portfolio. That is what you're looking from this asset class. So gold does two things, right? One is kind of diversifies your portfolio and becomes a store of value over the long run. So I don't think neither of them are done by silver. So gold is a better asset to own as compared to silver from a portfolio allocation perspective.
Right. So what is your outlook for gold? I mean, especially for Indian investors, traditionally at least 3 to 4 percentage points in returns annually have come from rupee depreciation. So going forward, what is the sort of outlook on?
So I think the rupee depreciation story, I don't think it's going anyway because we still have a current account deficit that we run. And structurally, until and unless we are reliant on crude oil imports, I think we would run that deficit on a structural basis. So maybe it could be up and down on certain time periods, but generally we'll see. So we kind of expect that rupee will continue to depreciate by about 2%, 2 to 3% per annum. It could be large, it could be small, but generally we think that is how the rupee will pan out. Coming to gold price exposure, because international gold price is a big determinant of how Indian gold prices also behave. So we think that we are coming to a place where interest rates may not go up from here on in a significant manner. Maybe another 25 or 50 basis point hike by the US Fed. Anytime they take a U-turn in policy making, when they start cutting interest rates, when they start reversing or adding more liquidity in the system, I think that will be the time, and that will happen when we see distress in financial markets, because we have seen time and again that is the thing that moves them in a larger way.
Right.
Whenever that happens, I think gold will get repriced, and as I said, gold seems undervalued from a monetary based theory, given gold is a monetary asset. Central banks also hold on gold, so from that perspective, I think gold should do well. Also, there's an argument that dollar overall as a percentage of reserves will kind of dwindle, which we have seen over last few years as well. It's been coming down. Dollar's share of payments also has been coming down. So we are looking at the dollar supremacy is kind of eroding to some extent. BRIC countries talking about their own currency as competing to the dollar. So all that tells you that if the dollar goes down, then probably gold again should go up. So we are seeing various things like, the savings glut that we had seen is coming to an end. So last time we checked, a couple of months back, it was about $700 billion of more savings left. So I think it's fast eroding, and as it kind of erodes further, that support to the economy may not be there, which will start reflecting in financial markets and compel the Fed to react. So there are certain things like, credit card debt reaching $1 trillion in the US, which also tells you that saving glut is eroding, because now people are, for the consumption, banking on more credit card debt as compared to, the savings that they had earlier. Also, if you see the loan officers survey in the US, that is also showing that lending standards are getting more and more tighter, which means that more and more people are getting out of the ambit of getting loans. So that makes them even go towards more unconventional sources like credit card debts to kind of fund their consumption. So overall, we are seeing signs of slowdown in the US economy, which will kind of start having its impact, and Fed may not be able to do much more, even if they see inflation staying stickier to some extent and not coming below their 2% target, which means a very, very good scenario for gold, where you are seeing a sticky inflation kind of scenario, and growth dwindling down and interest rates coming down. So that is a perfect scenario where gold should start doing well.
So thank you so much, Chirag, for this very insightful
Thank you so much.